Hi everybody, this is an intro to the Quantopian lecture series, so if you're already familiar with Quantopian and with the lecture series, please feel free to skip ahead. Quantopian is a crowdsourced investment firm, and our goal is to democratize quantitative finance and to level Wall Street's playing field by providing a lot of free tools and data of the same caliber that you would run into as a professional on Wall Street. Our business model is to provide capital allocations to the best algorithms that are developed on the platform. To this end, we've developed a pretty extensive educational curriculum to make sure that our users are well educated. The Quantopian lectures are developed in conjunction with and are used for teaching by professors at top universities all around the world. We also work with industry practitioners to make sure that all the examples that we teach are current and up to date with techniques that are actually being practiced in the field today. In general, we try to teach theory and intuition hand in hand, so that once you've learned a concept, you have readily accessible code snippets to then go out and apply it. Let's get right into it then, and see what we're getting into today. Today we're going to be going through the factor analysis lecture on the lecture page. The point of this lecture is to build up an intuition in order to properly assess and analyze factors for use in factor models, using our open source package Alphalens. That's Alphalens. You can find all the source code, download it yourself, clone the repo, contribute if you want, at github.com/quantopian/alphalens. So if we clone the notebook here, let's have a look at what we got. So what I mean when I say factor model is similar to what you have when you deal with the capital asset pricing model or when you deal with the Fama-French factors. With the capital asset pricing model, what we do is we hypothesize that the returns of a stock are in some way driven by the returns of the market at large. And we can typically assess this using some form of linear regression and just laying things out such that we find the beta exposure in the equation returns of a stock equal to alpha plus beta times the value of the market itself. So any sort of factor, we can just plug in where the market is and instead use that value. So we construct our factor portfolios in the same way that we construct a long-short equity portfolio. We have some number associated with every single stock. We calculate some number for everything. We then rank every stock in our universe based on its value from lowest to highest. We pick a basket that we want to go long on, which will be the top basket, the top quantile. And we pick a basket that we want to go short on, which will be the bottom basket, the bottom quantile. And in this way, we hope to capture the relative price movements of our universe of stocks. When we have the top basket minus the bottom basket, all we need to do is maintain a spread between them. Since we're getting the positive of the positive returns in the long basket and the negative of the negative returns in the bottom basket, we just end up with this spread between them, between the mean returns of each basket. And as long as this spread continues to widen, we continue to earn return. We're essentially earning an alternative risk premium based on our exposure to some weird alternative alpha factor. And this alpha factor can be just about anything. It can be some sort of sentiment factor of how people feel about the stocks in our universe of stocks. It can be the market cap of our individual stocks. As long as we think that there is some way, some driving force that associates the returns of our universe with the factor value that we're trying to calculate. So for this lecture specifically, I've built an example of a momentum factor. So what I mean when I say momentum is we essentially assign a score to each stock based on how it has been performing. We assume that stocks that have been performing well will continue to perform well. And this is captured in momentum. We define our momentum factor such that we take the returns over the past year up until the beginning of this last month here. And we penalize this by any sort of reversal that may have occurred in the most previous month. Now what we do is we import Alphalens here. We define our sector codes, and we define the universe that we're going to be using to rank using our factor. In this case, we use the Q1500 US, the Quanto 1500 US, which you can find by following this link on the forums if you want to see a little bit more about how we actually break this down. It's a series of complex pipeline filters that allow us to get a precise universe of stocks that we would actually want to trade. These Morningstar sector codes allow us to categorize all the stocks in our universe by which sector they fall into. And this will be useful, because later, using Alphalens, we can essentially break out returns and information by sector using these codes. Using Pipeline, we add the factor that we've defined up above, this momentum factor, as well as the sector, and screen our universe with this Q1500 US. We then pass in a starting date and an ending date, 2015 to 2016, over which we want to run our pipeline and calculate our momentum, and we're just going to time it. Just for fun, you know? This looks like it takes about a minute, a little over a minute to run, so I'm not actually going to run the code in this lecture, but feel free to follow along running the code yourself. So after we've run our pipeline, we extract our factor data here. And we see that for every single date in this time range, every single stock in our universe for a given day has a factor value, and that's important. Here we stored the sectors that we pulled from our pipeline. Again, these are going to be categorized by day and stock as part of the index. So once we have our pipeline run and all our data aggregated, we extract our individual factor value here. And we see that for each individual date, we have a factor value for every asset in our universe. Similarly, we pull out the sector for each asset every day in our universe. Here what we do is we extract the full set of stocks that passed in and out of our universe over this total time period. Since the Q1500 US is a dynamic filter, things are going to change. So it's not going to be exactly 1,500 stocks. It's going to be a little above that. And we just want to make sure that if at any point any of those stocks were in the top basket or in the bottom basket, or in any particular quantile, we just want to make sure that they're captured. Here, we get prices for over the entire length of time that we ran the pipeline, including one additional month, to see how it performs beyond what we've actually researched and beyond what we've actually drawn. And this is what the prices look like here. Now let's actually start messing around with Alphalens itself. So we have our factor values, we have our prices, and we have the sectors that correspond to each of our individual stocks in the universe. This is just pulled from the pipeline. And this is the dictionary that we defined up above. And here we define the periods that we want to look forward. So what this function does is it basically cleans up the prices associated with each factor and separates everything into quantiles, puts it all in one big friendly data frame that we're going to be playing with for the rest of the lecture. Calculating this factor data here using the clean factor and forward returns is really the key thing that we need to take away from. All the surface level API stuff can operate solely with these forward returns that we've extracted. What we're going to do now is we're going to just break down these individual components and make a lot of plots individually. And then I'll show you how to make all the plots at once so we can skip the annoying in-between steps. But this is what our factor data looks like here. We have for each date and every asset, the 1-day forward returns, the 5 and 10-day forward returns, the factor value on that day, the group, the category that it's been put into based on our Morningstar sector codes, as well as the factor quantile. So in this case, what we've done by default is just separated into quintiles. So there's quantiles 1, 2, 3, 4, and 5. What these forward returns are is kind of simulating how these stocks would have performed over different time periods. So basically, how we can think of them is if we have the 1-day forward return, if we had magically held all these positions yesterday, a return to today would be in this column. The 5-day return is, well, if we had magically held everything in our universe that we want to hold this day, well, 5 days ago, our return up until now would be the 5-day forward return. Similarly, the 10 days is for magically holding stuff 10 days ago, and then the return over that 10-day spectrum. What we do here is we essentially extract this mean return by quantile. So we're just going to calculate the mean return for each quantile, each individual day, as signified by this by date flag here. And this is just a little snippet of what quantile 1 looks like for each date. These are the returns of each set of forward returns. Here, rather than looking at it by date, this is just the mean return over all time. See how we're saying by group is false? We're not interested in looking at how it's broken down between sector. So here we get each quantile. This is the mean return for each basket for each set of forward returns. And this is what we're going to use. Well, this is a basis of what we're going to use to sort of assess the profitability of the spread. What this plot here does is it plots the mean return for each factor quantile. Based on what we've calculated here, this mean return by quantile up above, this is now plotted as bars with a different color for each of the individual time periods. This is the 1-day bar, this is the 2-day bar in green, and this is the 10-day bar in red. And what we've done here is we've essentially standardized these so they're on the same scale of each other, just by turning them into growth rates rather than looking at the flat return. Here we're looking at the violin plots, which show the same thing as above, but this time we get an idea of the density of where our returns are concentrated for each time period. Here what we do, using this mean return spread function, is we're going to calculate the spread between the upper quantile and the lower quantile, the 5th and the 1st, and we're going to have this standard error, and we're just going to plot it and make it look nice. So this is this rolling estimate in orange of a 1-month average over this mean return spread, just to smooth out all this noise so we can get a better idea of what's going on. In this blue, this is how this spread between the returns behaves. And this is for the 1, 5, and 10-day time periods. Here, what we do is we plot the cumulative returns for each quantile. So we take the mean return by quantile daily, and we aggregate it over all of time. So what we want here is for these to just spread out away from each other. We see with this momentum factor that there's a lot of a weird crossing over, but after a little while, it starts to behave as we'd actually want it to. See how this 5th quantile is pretty clearly above the 1st quantile, and this seems to be getting wider as we go. Here we calculate the long-short factor returns using this factor returns value. So if we had put this factor into a long-short equity algorithm, these are the returns that we would get for each day over each time period. Here, we're just going to index those returns that we got and just plot the 1-day forward returns. And this is the cumulative return of a long-short equity portfolio that used this factor. Here what we do is we calculate the alpha and the beta of these returns, of the returns of this long-short equity portfolio. So this is alpha and beta expressed in terms of market beta. So what we do is we take the returns of the portfolio, we set them equal to alpha plus beta times the market, and that alpha, that intercept, is this value here for each time period, and that beta, that exposure to the market, is this value here for each time period. If we want to extract everything that we had above this, what we do is we just can call this create returns tear sheet method on the factor data function that we got from getting the clean forward factor returns. We only really need to do this in order to generate all that stuff that we had up above. I just wanted to break stuff out. Now let's walk through the information section of an Alphalens tear sheet. We quantify information by calculating the information coefficient, or the Spearman rank correlation. These are two names for the same thing. And what we do is we essentially calculate the correlation between the factor values and the forward returns for a given time period. So essentially, we're correlating the rank with the return of that rank. So if there's a very high Spearman rank correlation, that would indicate that high values of our ranking scheme correspond to high return values, and low values of our ranking scheme correspond to low return values. Essentially, this quantifies the predictability of our factor. So in order to actually calculate this, we'll pass in our factor data into the factor information coefficient function here and store that in IC. If we look at the IC, we get the 1, 5, and 10-day forward IC by date. And this is just the mean IC by date for each of these individual baskets. Here we plot a time series for each of our time periods of the information coefficient. So this noisier line is the bare information coefficient, and then we plot a 1-month moving average over it, just to smooth it out a little bit. And here we can see how the predictability of our factor changes over time, or over the time period that we have calculated it over. Here we use a histogram to plot basically the distribution of how our information coefficient operates. And here we just see it's a histogram, and we overlay a distribution on top of it. Here we plot a quantile plot, or a QQ plot. And this is to compare the quantiles of our information coefficients distribution to the quantiles of a normal distribution. So basically, if our information coefficient was normally distributed, then every single quantile would line up along this y equals x line. What we actually want to see is more of an S shape here to indicate fat tails, because that's where we're actually going to be making our trades. Here we calculate the mean monthly information coefficient using this function, and we plot a little heat map of it, just to get another visual representation of how the IC changes over time. As with the returns tear sheet, we can calculate the information tear sheet, which will just give us all the information that we want related to the information section of the Alphalens tear sheet up above. Now let's walk through the turnover section of an Alphalens tear sheet. Turnover is going to be very important to help assess the quality of our factor, just because, well, if our signal isn't strong enough and we have a lot of turnover of stocks moving in and out of our top and bottom quantiles, well, then the commissions costs are just going to totally eat up whatever signal that we have if it's not good enough. So we have a few different ways that we actually quantify turnover. First, what we have is we just calculate the turnover itself. We just pop in this factor data here and calculate the number, well, the percentage of our top and bottom baskets that are turning over for each time period. And this is just a good baseline to look at. Another interesting way to assess turnover is by using factor autocorrelation. So what we do is we take the correlation between our current factor values and our previous factor values for each time period. So if our factor autocorrelation is particularly high, or close to 1, then that would indicate that we have relatively low turnover, just because our factor values that are current are based on our previous factor values. So as long as things are still predictive, as long as our stocks that rank highly continue to have highly ranked factors, then they're going to stay in their own baskets. And that we signify by just plotting this factor autocorrelation here. And we see that with this momentum, the mean seems to be about 0.986, and the actual time series of our autocorrelation is fairly consistent across time. Again, we can generate all these graphs just using the turnover tear sheet command itself. And we can just calculate that if that's all that we want. So this last section here, the group breakdown, is where those Morningstar sector codes that we defined up above actually come in handy. What we do is we say we want the IC by sector here, and we say we do want it by group. And the groups that we have are the Morningstar sector codes. So what we do is we calculate the mean IC for each time period for each individual sector. So we can assess the predictability by sector rather than looking at the entire market as a whole. And this is important, right? Just because, well, we might want to assess where the signal is coming from. If it's more predictive in one part of the universe than another, then that's something that's worth knowing. What we want is for our factor to be consistent across all sectors, all breakdown of our universe. But this allows us to see where stuff is actually coming from. So once we've calculated our IC by sector, we can plot it just using this plot IC by group. And this is going to give us the 1, 5, and 10-day forward mean ICs for each individual sector. We can also calculate the mean return by sector. And we just do that here. We say we want it by group. And then we can plot those little bar graphs for every single individual sector. And this shows us the return by basket for each sector. And as we can see, well, while our breakdown of baskets for all the time periods up above was relatively consistent from the bottom basket up to the top, these individual sectors are a little bit all over the place, if we're being honest. Like this energy sector is incredibly negative, but that seems to be balanced out by this healthcare, which is incredibly positive. So there's a lot of different stuff going on. This is just another thing to help you diagnose the quality of your factor. So if we want all of that stuff that we've already generated, all we have to do is say that we can create the full tear sheet and say we want it by group. We don't need to do any of the individual tear sheets. We can just run this single command, and it's going to generate all of that stuff above in one convenient set of graphs, as well as calculate some other stuff on the factor. This is also going to include some extra graphs that we haven't gone through today, just because, well, this lecture is just meant to be a basic overview of how we would look at a factor, how we would analyze a factor, not a direct guide to the API of Alphalens. You can find all the commands and all the details on how Alphalens works at github.com/Quantopian/Alphalens. This tear sheet allows us to assess in a vacuum the signal of an individual factor. This is part of the research step. So all the stuff that we've done so far is just to kind of simulate if we were to trade it. This doesn't include any actual market impact stuff that we would want to have in order to determine as a final step whether a factor was viable. So this doesn't take into account slippage or commissions. We do have some measures of turnover, but when it comes to actual market impact, that comes into play when it comes to commissions. So what we want to do, in order to actually properly iterate on our research and to develop factors, is we want lots of different tear sheets on lots of different factors. We compare our tear sheets between themselves in order to determine which is the best out of the group of factors that we have created. Then finally, we take those best factors and we put them together in a back test to actually assess the market impact of them. Or we use them in whatever other ways to assess the exposure of our algorithms to novel risk factors. In addition to assessing individual factors, well, what you can do is you can just create some big aggregate factor. You can standardize 3 or 4 factors and take the sum of all of those as one factor, one composite factor value, and run that through Alphalens to see how the resulting combination, the resulting aggregate performs as a predictor. This is just one theoretical way that you could start to combine factors. I know that there's some examples of combining factors using machine learning or using other techniques on the forums. So definitely check those out and pass those through Alphalens once you've calculated them, or once you've got your momentum factor and a few others. See if you can aggregate them together in an interesting way to come up with a cool tear sheet. This factor tear sheet is a good start for assessing the quality of our factor, but we do need to include it in an actual back test before we go about considering it as an actual algorithm. For a basic idea of how you would actually implement a factor in an algorithm, you can just go over to the lectures page and clone the long-short equity template algorithm on that page there. You can just replace whatever factors we have with the factor code from up above and immediately run the backtest and see what happens. You can also incorporate factors however you see fit in some algorithm of your own design. Really, the possibilities are endless. Hi, everybody. Thank you for watching the Quantopian lecture series. If you have a desire to see any more of our content, it is all available at www.quantopian.com/lectures. If you're already on the Quantopian site, you can also get to this page by going over to Learn and Support, clicking on Learn, and then this lectures link will bring you right back here. All of these lectures have a notebook associated with them, which contains a theory and applications for the lecture. It's the real meat. Many of these lectures will also have a video associated with them that you can watch, just like the one that you just watched. And then some of these lectures are going to have algorithms that you can clone and iterate on just to give you a basis to start with your own algorithmic trading ideas. We also have a GitHub, which is at github.com/Quantopian/research_public. All the stuff that's on our lectures page is also here if you dig around. You can also follow me on Twitter at clean_utensils. And we also have, last but not least, some resources available for any sort of academics who want to incorporate the lecture series into their classes. All of this stuff is free. We just like to provide a little bit more guidance for professors who want to get Quantopian involved with how they teach. Lastly, you can email me at max@quantopian.com, and that's just max@quantopian.com. Feel free to send me any sort of feedback, any sort of questions you have about the lecture series. We're always looking to improve things, so we always want to hear comments about how we could make it better. Thank you so much.